We have Ben Bernanke, former chair of the Fed, John Mack, former CEO of Morgan Stanley, who were on opposite ends of some phone calls back on a Sunday in the fall of 2008, when you were facing a pretty dire situation that affected all of financial markets, basically. You had bank after bank, institution AIG, other financial institutions after institution looked like they were going to go belly up, frankly, and you were worried about meltdown. You were fighting to keep Morgan Stanley afloat, basically. I'd like to go back because you actually talked with each other at a time when, Ben, you were saying, we've got to do something, and really, perhaps you should think about selling your company, John. Take me back through what you were thinking about. You talk about some in the book, but only sort of a glancing blow. You thought they were going to get the Chinese to bail them out, perhaps.
Well, after Lehman, and John could talk more about it, there a lot of pressure turned on the remaining investment banks, on Morgan Stanley and Goldman Sachs. And one of the things that the Fed did was to make the two companies bank holding companies, which were mostly symbolic. It was mostly essentially assuring the market the Fed would now be overseeing those companies from a supervisory point of view. But Morgan Stanley and Goldman Sachs both went out and got investors, private investors, and that was really key to strengthening the firms.
But it didn't happen right away.
No,
up to the moment.
Weeks, yeah.
Well, it didn't happen right away, but it was in the works, working it the whole time. And the conversation that Ben and Hank Paulson and Geithner and I had was a very forceful conversation on what they wanted Morgan Stanley to do, which, as he remembers, I was not going to do that.
And what did they want you to do?
They want us to sell the firm for $2 a share.
And to sell it to?
J.P. Morgan.
Yeah, and
in all fairness, it was Tim who wanted that. I don't know where it was.
Yeah, I wasn't on that conversation.
It was Tim, with all fairness.
And was Jamie Dimon interested? Would he have bought it at that?
He was not interested, and he said, all I would pay you is $2 a share.
Yeah.
We had 3 or 4 conversations that Tim kept saying, call Jamie, and that Jamie didn't want to do it, and I didn't want to do it, but when the head of the New York Fed is pushing you to make those calls, you make the calls.
So after the fact, when we look at the last few years and the problems banks have faced since these acquisitions, is it fair? Because when we look and say, well, it was the Fed who pushed the banks into these trades, one would say.
No, that's not fair. You're talking about to get us in this position? No, the street, look, when you just make money and the market's going your way and you can borrow low, sell high, you can securitize, and people are making 20, 30% in ROEs with their stock, someone's got to blow the whistle. They got carried away. And leverage was wild. I mean, when you think about the leverage these firms had, including Morgan Stanley, it was absurd. But when everything's going up, everyone wants to play. And I remember calling Tim on a leveraged loan deal that we were trying to make. We were uncomfortable with it. We kept passing, and finally our guy said, look, we have to be involved. We've passed on the last 3 deals. We get involved at, let's say, 6 times leverage, which is ridiculous. And then once the sponsor had the leverage, they turned it again to 7 times leverage. We dropped out. I called the head of the New York Fed and said, we're out of control. Said, I can say no to 1, 2, maybe 3 deals. On the 4th deal, I have to play.